Let me ask you something uncomfortable. What if your bank already knows something about your future? That you don't? Not your balance, not your transaction history. Your future. Imagine this. You apply for a loan next month. You've done everything right. No missed payments, stable job, savings intact. You're confident. But the application gets rejected. Not reviewed, not debated, rejected automatically. You call customer service, and the representative says it didn't meet internal risk thresholds. Internal risk thresholds. No explanation, no human decision, just a system. Now here's the question nobody's asking. What if that system predicted you were risky? Before you ever became risky, we tend to imagine financial decisions happening in boardrooms. Executives, analysts, loan officers studying files. But that world is fading. Across the US and UK, financial institutions are increasingly relying on artificial intelligence to evaluate customers in real time. Not just for fraud detection, not just for credit scoring, but for prediction. Modern AI systems monitor spending patterns, income volatility, subscription behavior, geographic movement, device consistency, economic signals, market shifts. Banks no longer just analyze what you did. They analyze what you are statistically likely to do next. That shift from reaction to prediction is subtle, but it's massive. Because once prediction becomes the standard, your financial identity becomes probabilistic. You are no longer judged by facts. You are judged by forecasts. You know your credit score, but you don't know your behavioral risk profile. And that's where things get complicated. Many financial institutions use internal AI-driven scoring systems that go far beyond traditional credit ratings. These models don't just ask, "Did you miss a payment?" They ask, "What behaviors correlate with someone who might miss a payment later?" They examine patterns like, are you increasing small impulse purchases? Did your grocery spending drop suddenly? Have you changed devices frequently? Did you relocate recently? Has your transaction timing shifted? Did your income source change? Are your savings gradually decreasing? Individually, these signals are harmless. Together, they form a predictive model. If similar behavioral clusters historically led to late payments, job transitions, or defaults, the system adjusts. Sometimes quietly, sometimes invisibly, sometimes months before anything actually happens. You don't feel risky, but the model doesn't measure feelings. It measures probability. Now here's where this becomes unsettling. AI doesn't need to control your bank account to shape your life. It just needs to influence access. Imagine the system flags you as slightly higher risk. Not high risk. Just slightly, your credit limit drops by 10%. Your interest rate increases. Your insurance premium adjusts upward. Your mortgage pre-approval shrinks. Nothing dramatic. Just small recalibrations, but across millions of people. Small recalibrations reshape economic mobility. And here's the part most people miss. Financial systems operate on margins. Small percentage shifts compound. A slightly higher interest rate over 30 years becomes thousands of dollars. A slightly lower credit limit reduces flexibility during emergencies. A slightly stricter approval threshold delays opportunity. Not catastrophic, just limiting, quietly limiting. Let's pull back the curtain. These systems use machine learning models trained on massive data sets, millions of financial histories. They analyze regression patterns, behavioral clustering, neural networks, risk-weighted capital models, time series forecasting. The algorithm doesn't understand your dreams. It understands correlation. If thousands of people who shared your spending profile later struggled financially, you inherit statistical caution, even if you personally are disciplined. Even if your situation is stable, the model isn't personal, it's mathematical, and math scales. Now push the idea further. What if the system predicts you are likely to change jobs within 9 months? And historically, job transitions increase short-term financial instability. So your access tightens today. What if it detects spending rhythm shifts consistent with stress markers, so it flags potential volatility? What if your geographic move matches patterns historically associated with higher default rates, so your borrowing capacity adjusts downward? You never said you were stressed. You never said you were unstable. You never asked for intervention. But the pattern matched, and the system recalibrated. No conversation, no warning, no transparency. Just recalculation. If predictive AI models become the backbone of lending decisions, opportunity becomes algorithmically filtered. Access to capital shapes, business creation, home ownership, investment growth, educational mobility, generational wealth. If predictive systems begin nudging access up or down based on probability, entire segments of society may feel subtle resistance. Not enough to protest, not enough to notice immediately, but enough to compound. And compounding is powerful. Economic inequality doesn't always explode. Sometimes it slowly drifts, one recalibration at a time. Here's the twist. AI doesn't need malicious intent to create imbalance. It just needs optimization goals. Banks optimize for minimized risk. Investors optimize for stable returns. Insurance companies optimize for projected exposure. And AI is exceptionally good at optimization. If the algorithm decides certain behaviors statistically correlate with instability, it will protect the institution, not necessarily you. That's not evil. It's efficient. But efficiency without transparency is difficult to challenge, because you can't argue with a probability score you can't see. We are shifting from a world where you prove yourself to a world where you are predicted. Before you default, before you struggle, before you fail, predicted. And once you are predicted, your opportunities adjust around you, quietly. You may never know that a model calculated your probability curve, but you'll feel the outcome. Lower approvals, higher friction, more verification, more scrutiny, subtle constraints. And over time, subtle constraints shape reality. So the real what if isn't whether AI controls your money. It's this. What if AI is already shaping your access to opportunity and you don't even realize it? We are entering an era where data becomes identity. Identity becomes probability. Probability becomes policy. Policy becomes financial reality. The next decade won't just be about earning more. It will be about understanding the systems evaluating you, because the people who understand the algorithms will adapt faster than the ones who ignore them. They will structure their financial lives differently. They will protect their behavioral data. They will anticipate how predictive systems interpret signals, and they will move strategically. AI in finance isn't inherently dangerous. It has benefits. It reduces fraud, speeds up approvals, improves efficiency. But when prediction replaces conversation, human nuance disappears, and nuance matters. Because you are more than a cluster of historical averages. You are more than a statistical projection. But to the model, you are data, and data is probability. So here's the final question. If an invisible system is quietly evaluating your financial future, shouldn't you understand how it works? Because once you understand the system, you stop being surprised by its decisions. And in a world increasingly run by algorithms, awareness becomes leverage. If you want to understand how AI is reshaping finance, engineering, and economic power, subscribe. Because the biggest financial shifts of our lifetime won't be announced loudly. They'll happen quietly, inside systems, inside models, inside predictions. And the people who see it early will always have the advantage.